Marlowe was designed to make it really easy for financial practitioners to express their contracts in a way that works easily and smoothly on the blockchain. We have seen zero-coupon bonds, airdrops, and multi-party auctions. But how good is Marlowe to bring futures and options, widely used in traditional finance, to Cardano? Why are there currently no futures or options anywhere on DEXs? And what would it take for this happen in the future? This section looks at the most commonplace derivatives types and explains the problems they face in a permissionless Web3 world. UTXO versus account-based blockchain systems are not part of our discussion. While they surely have huge consequences for finalizing smart contract design, Marlowe is agnostic as it itself is based on the accounts model, but runs on a UTXO chain. If major issues like clearing and custody can be solved, this is unlikely to be too much of an obstacle. So how could a future be difficult, where we already have a working CFD with Oracle among our Marlowe templates? Let us understand first how a futures contract works. Instead of buying ADA today with dollars, you buy ADA for delivery at a specific future date for an initial margin payment of 20% of the full dollar amount. If ADA drops 10% in value, you need to top up this loss. This 10% extra payment is called a margin call, and the level where it is triggered is the maintenance margin. Futures are not provided by some big brother centralized entity, but can be bought long or sold short. For every buyer, also called long, there is a matching seller, called the short position. In traditional finance, they both have a clearing house as their counterparty. This clearing house ensures that the party underwater tops up their margin, or is liquidated and replaced by a new, solvent long holder. This is a system based on reputation of the clearing house. The contract for difference we have seen so far in Marlowe Playground is for finite payments between Alice and Bob, or some role-based parties, and an initial deposit or down payment in full. Theoretically, periodic adjustments could also be triggered as choices, or market events could be inserted as notifications in event of. However, it is hard to see a case where a futures party that is not delinquent will not terminate in case their counterparty becomes delinquent. We have roll tokens in Marlowe, so passing the roll token to another address could be a possibility. Solving all eventualities of a margin system without a central, benign and highly capitalized party is however very difficult. If you are planning on introducing futures contracts, which are very popular in commodities market, a certain degree of centralization is inevitable. It will also help to move some parts of the logic off-chain and design a number of scripts that can transfer value only when necessary. On the plus side, futures are incredibly straightforward outside the margining mechanism. For every unit the price moves in a certain direction, the exact same delta is reflected in the profit or loss. And one party's profit is always the other party's loss in a transaction. Even within the confines of Blockly logic constructs, this is easy to realize, and we have in fact seen actors contracts, forwards and contracts for differences that can make such payments and transfers between parties. Where it becomes more involved is the calculation of payment amounts that is not fixed like a bet, but algorithmic based on the price fluctuation over a period prior to the timeout. We need to modify our Oracle role to insert the correct profit or loss amount, and this has to be acceptable to both parties without mediation, as the functioning of a market would otherwise not work. Starting fairly centralized and then refining your scripts to decentralize over time is recommended for this endeavor. Next, we look at options. Options contracts are more complex than futures as their payouts are conditional on the buyer of the option exercising their right to buy or sell the underlying asset. Shown here is the profit and loss diagram of the buyer of a call options. That means the right to buy ADA or some other native asset at a fixed price called strike price. Think of this price as $1 for 1 ADA. If the ADA price is 120, you want to exercise the option and receive ADA at 1.0. If it is, however, trading at 80 cents, you will let your option expire worthless, instead of buying at a loss. Shown as market price is the price you paid for this right, which is higher the longer time you have to decide, and the closer the current price is to your strike price. If ADA is trading at 130, your $1 call should cost at least 30 cents. even if you have only days to make use of this right. Where it becomes complicated is that there is more to it than this. How about the side that provides the right, aka the writer of the option? This party risks an unlimited loss for a small premium. This clearly only makes sense if they operate more like an insurance company, meaning selling calls and puts across various assets to balance their losses and capture the average profit of being the house, while avoiding being wiped out by a single bad trade. Even if we simplify this transactions to Alice and Bob sitting under the buttonwood tree and making a single Marlowe contract for a call, how much deposit should Alice put up to give Bob the right to buy Ada at $1 for say 3 months? If Ada goes to $10, either because of some amazing tech breakthrough or a serious loss in the dollar's value, can Alice survive and pay Bob? Decentralized finance is a great idea, and we need to explore crowd finance platforms. But clearly, without trust and large operators, options are hard to realize. Initially, a fully covered collateral is inevitable. So the short seller of any option needs to deposit the asset in question into a smart contract, and maybe earn adequate interest that is partially paid for by the option's premium. There are American-style options that can be exercised at any time during the contract validity, and European-style options that settle only at the end of the period or timeout of our Marlowe smart contract. Both are quite possible, but if you are thinking about decentralized options, European option style may be a better way to start, and then later fine-tune your contract accordingly. Interestingly, the term Asian options also exists, but it describes an option on the average price of the period. This makes the option harder to value and trade, but for smart contract design and Oracle, this should be quite similar to European style. Project Catalyst has seen proposals by Genius Yield Protocol submitted to several funds to realize options on Cardano. The team has strong expertise in Plutus smart contract development and has various doctor-level researchers among them. Unfortunately, they did not get voted into receiving the grant request, so we have not yet seen anyone deal with the possible problems in real life. If you are curious, you can search for options in the Lido Nation Explorer and see previous ideas by others, and maybe even check out their GitHub profiles and light or white papers for their ideas. Scaling and speed of the blockchain have improved tremendously over the last few years, but DeFi innovation is waiting for curious, bold, and clever projects maybe just like yours to move the needle and solve the hardest questions in the decentralized exchange and representation of value, safe from hacks and without trusted parties.